Welcome. In this video, we'll tackle the $500 dilemma, how to choose the right investment account for a 1-year-old. We'll compare 529 plans, UTMA, UGMA, custodial accounts, custodial IRAs, and the option of investing under a parent's name, plus safe parking spots like HYSA and CDs. We'll emphasize purpose first, education, flexibility, or retirement, and call out key tax, withdrawal, and financial aid implications. Let's begin and build a simple, confident decision path. Here's our roadmap. First, why starting early matters. Next, we'll walk through 3 primary account paths: the 529, UTMA or UGMA, and the custodial IRA. Then we'll add the parent-owned account and safe parking options like HYSAs and CDs. We'll bring it together with a decision flowchart and a side-by-side comparison. After that, we'll outline clear action steps, test your understanding with a quick quiz, and finish with key takeaways and an important disclaimer. Compounding makes early contributions incredibly powerful. Starting at age 1 amplifies growth over a long runway. However, improper account selection can lead to penalties, access problems, and unhelpful tax outcomes. With that in mind, let's move from the big picture to a practical overview of the 3 primary paths. Here's the high-level landscape. If your goal is education funding, the 529 plan is typically the top choice. If you want the fewest strings attached for non-education goals, consider a UTMA, or, alternatively, keeping funds in a parent-owned taxable account. If your primary goal is retirement funding for the child, a custodial IRA can be powerful, but is largely inaccessible for decades. Finally, if you're undecided or need a safe place to park cash for a short period, consider a high-yield savings account or a certificate of deposit. Next, let's break each one down. The 529 plan is purpose-built for education. Contributions grow tax-deferred, and withdrawals for qualified educational expenses are tax-free at the federal level and often at the state level depending on your state. Qualified uses include college, many trade schools, and limited K-12 tuition. Some states offer a deduction or credit for contributions. A newer feature allows certain unused 529 funds to be rolled over to the beneficiary's Roth IRA, subject to a lifetime cap and various IRS rules such as account age and annual limit constraints. The trade-off is that non-qualified withdrawals are subject to income taxes on the earnings and potentially a penalty, and your state may claw back prior tax benefits. If education is the goal, this is often the gold standard. Next, let's look at the flexible alternative. This flowchart starts by asking the most important question: what is the primary purpose of the funds? If the goal is education, it directs you to a 529 plan and prompts you to check your state's tax benefits. If the goal is flexibility, or if you are undecided, it offers UTMA, or a parent-owned taxable account, while flagging the risk that a UTMA transfers full control to the child at the age of majority. If the goal is retirement, it points to a custodial IRA and reminds you that contributions require the child to have earned income and that funds are largely inaccessible for decades. If you are not ready to decide, it suggests temporarily using a HYSA or CD. The flow ends with opening the account and automating contributions. A UTMA or UGMA is a general-purpose custodial brokerage account. You can invest broadly, and the funds are intended for the child's benefit without education-only restrictions. This is practical for families who anticipate non-traditional paths, such as trades or entrepreneurship. The critical trade-off is control. At the age of majority, the child takes full legal ownership, and you cannot prevent spending. Unearned income can be subject to kiddie tax after small allowances. For financial aid, these accounts are usually treated as the student's asset and given a higher assessment rate versus parent assets. Now let's consider the custodial IRA. A custodial IRA can be an incredible long-term wealth tool, but only if the child has earned income and your goal is retirement. The drawback is access. Funds are generally locked until retirement age, subject to limited exceptions. If your real objective is to support education or a business in the next 2 decades, this vehicle can tie your hands for too long. Next, we'll compare the top contenders head-to-head. Comparing 529s and UTMAs clarifies the trade-offs. A 529 offers tax-free withdrawals for qualified education, potential state incentives, and parent control, but penalizes non-qualified uses. It's typically treated more favorably than child-owned assets for financial aid. A UTMA, offers broad flexibility and no education restrictions. But the child gains control at majority age, and unearned income may be subject to kiddie tax. UTMA assets are often weighed more heavily in aid calculations. Choose based on whether education-specific tax benefits outweigh the need for flexible access. Here is a quick reference table. The 529 plan focuses on education with strong tax advantages, but penalizes non-qualified uses. The UTMA, or UGMA, allows broad spending for the child, but transfers control at majority and can carry kiddie tax exposure. A custodial IRA is excellent for retirement growth, but is generally inaccessible for decades, making it mismatched if you need funds earlier. A parent-owned taxable account maintains parent control, but shifts taxes to the parent and can affect aid. HYSA and CDs are suitable for short-term parking with immediate or time-bound access, at the cost of lower expected returns. This timeline illustrates how early dollars can grow by the time the child reaches age 18. Starting with a small lump sum and modest monthly contributions, compounding has many years to work. The balances at ages 5, 10, 15, and 18 ramp up due to growth on growth. These are estimates, not guarantees, but they highlight why time in the market matters. Now let's translate these insights into a simple, step-by-step plan. Here is a simple process. First, clarify the primary purpose: education, flexibility, or retirement. Second, research your state's 529 benefits and plan expenses. Third, decide how comfortable you are with the UTMA transferring control at the age of majority. Fourth, consider financial aid implications of parent versus child-owned assets. Fifth, if you are undecided and the decision is time-sensitive, use a HYSA or CD temporarily. Sixth, open the chosen account and set an automatic monthly contribution. Finally, review annually as goals and rules evolve. Question: if college is the primary goal and your state offers a tax deduction for contributions, which account is usually the best fit? Options: A. UTMA or UGMA. B. 529 plan. C. Custodial IRA. D. Parent-owned taxable account. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is the 529 plan. It is designed for education, can provide tax-free qualified withdrawals, and many states offer deductions or credits for contributions. These features generally make it the best fit when college is the primary goal. High-yield savings accounts provide liquidity and are typically FDIC or NCUA insured up to legal limits. Certificates of deposit can offer higher rates if you lock funds for a term, but they may charge early withdrawal penalties. These are useful as temporary holding places while you decide on the longer-term account structure. Some parents choose to keep the funds in a parent-owned taxable account. This can simplify control and allow flexible use as goals evolve. However, capital gains are taxed to the parent, and depending on the aid methodology, parent assets can still affect financial aid. Later, you can gift funds or pay expenses directly. This approach can be effective but requires careful tax and aid planning. Next, let's test your understanding with another quick quiz. Question: which account exposes you to the risk that the child gains full control at age 18 to 21, regardless of your wishes? Options: A. 529 plan. B. UTMA or UGMA. C. Custodial IRA. D. Parent-owned taxable account. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is the UTMA or UGMA. These custodial accounts transfer full legal control to the beneficiary at the age of majority, and you cannot legally prevent the child from using the funds as they choose. To emphasize compounding, consider a simple illustration. Suppose you invest a $500 lump sum and add $50 per month at a hypothetical 7% annual return. Over 17 years, the combination of contributions and growth can generate a meaningful balance by college age. A quick mental check is the rule of 72. At around 7%, money doubles approximately every 10 years. These are rough estimates, not promises, and actual outcomes depend on market returns and your investment allocation. This pie chart shows one illustrative way to allocate an initial $500. 60% to a 529 if education is likely, 30% to a UTMA for flexible future needs, and 10% in a HYSA to keep some liquidity. This is purely an example. Your ideal mix depends on your confidence in the education goal, your tolerance for the UTMA ownership transfer, and your preference for near-term flexibility. The most important takeaway is to decide the purpose first. If education is the goal, a 529 plan usually shines, particularly when your state offers tax benefits. If flexibility is more important, a UTMA or a parent-owned taxable account may be better, keeping in mind the UTMA ownership transfer. Custodial IRAs require earned income and are best when retirement is the objective. HYSA and CDs are helpful short-term parking tools. Whatever you choose, automate contributions and reassess annually. Disclaimer: this content is educational and not financial, tax, or legal advice. Consult a qualified professional who can review your individual circumstances. State and federal rules, including tax laws and financial aid methodologies, can change and vary by jurisdiction. Verify details like state 529 tax benefits, kitty tax thresholds, and IRA rollover rules before acting. To conclude, decide your purpose and match the account accordingly. Use a 529 for education, a UTMA or parent-owned account for flexibility, and a custodial IRA for retirement with earned income. If you are undecided, park funds in a HYSA or CD temporarily. Automate contributions and revisit the plan annually as goals and rules evolve. Thanks for watching. If you found this helpful, please like the video, share it with another parent who's weighing their options, and subscribe for more practical money content. In the comments, tell us how you would allocate your $500 and why. See you in the next one.